Hey, it's Matt Decker with Cash Value Life Insurance Reviews and Leveraged Wealth Management. I'm making a video today about Index Universal Life, specifically around the fees. Now, if you've ever purchased a universal life insurance contract, or if you're thinking about purchasing an Index Universal Life Insurance contract, you absolutely need to understand the importance of fees. And I would recommend that you look at several different carriers, at least two, to make sure that you're getting the best deal. And really, what it all boils down to is this. Fees are important because fees happen every year. There is no year where you just don't pay any fees. So every single year, fees come out of your contract. Now, why is this important and why am I even mentioning this? It seems pretty self-explanatory. Well, the reason I'm mentioning it is because there are other things that lots of advisors lean on to sell these contracts that maybe don't happen every single year. And a great example of something that won't happen every single year is something like a 20% rate of return. So let's assume that there's a policy out there that has a 20% cap, okay, which is a relatively high cap in this Index Universal Life Insurance space. That means that you can make up to 20% per year. Now, on the face of it, that sounds phenomenal. And you might be inclined to purchase this policy because it has a 20% cap, let's say. But what's important to understand is that you're not going to hit that cap every single year. You might hit that cap, let's just say 2 years out of 10. So what that means is you've purchased a policy that has this really phenomenal, great, high cap, but you're only going to hit that cap 2 years out of 10. 10 years out of 10, you're going to have fees come out of your account. 10 years out of 10. Every single year, fees come out of your account. So if this particular policy were to have some of the most expensive fees in the industry, that would give you cause for concern. Because now you're purchasing a policy that every single year is going to be expensive and have fees come out, but you may only hit this 20% cap 2 years out of 10. So it's extremely important to understand not only the bells and whistles and the sizzle around your policy, but hey, what are you paying in the way of fees in order to get the sizzle? So that's what we're going to talk about today. It's going to be a short video. I'm just going to show you a couple examples of the difference in fees, and every example we're going to look at, we're making it simple, is just going to be a 45-year-old male looking at a $1 million policy. So a 45-year-old male looking at a $1 million policy, and let's compare the fees. So here's the first policy that I want to look at. Again, 45-year-old male, standard non-tobacco, $1 million policy. And all I want to do is show you the total fees paid through 30 years. So this is the policy charges ledger. And what it does is it shows the actual fees paid every single year for the life of the contract. And it totals it up for us over here on the right. This is an Allianz policy. And if we go down to year, let's just say 30, and if we were to total up the fees paid from year 1 all the way down to year 30, the total would be $144,394. That's total fees paid for the first 30 years inside this contract. Now, seeing this by itself really doesn't mean anything because there's no context around this $144,000. There's no way to know if this is good, if this is bad, if this is ripping you off. You have no idea. So you have to compare it to some other policies that are out there. So I'm going to compare it to 2 others that are out there. Now, full disclosure, the other 2 that I'm comparing it to are going to be more expensive, but I want you to see just how much more expensive these policies can get. So let's look at Minnesota Life. Minnesota Life, again, same idea, 45-year-old male, standard non-tobacco, $1 million. You'll notice that the premium is different. The premium is different in all 3 of these cases, which is why we're not really comparing the cash values. We just want to look at the fees. So here's our policy charges summary, and Minnesota Life does a nice job of breaking out all the different charges and then totaling it up for us every 5 years. So the numbers that you see in bold are going to be the totals every 5 years. So let's go to year 30 because that's what we're keying in on. So here's year 30. And if we add this up across the rows, what we end up with is 342,190. 342,190 through 30 years. So the Allianz total, if we were to add it all up, was 144,394. The Minnesota Life, if we total it all up through 30 years, 342,190. Let's look at one more. So this is Pac Life, and again, this is the exact same thing, male, 45, non-smoker, $1 million policy. And Pac Life, again, has this policy charges report. They do a nice job of totaling it up every 10 years. So if we scroll down to year 30, we're going to see the total. Here's our premium loads, rider charges, coverage charge, COI, and then they actually total it up for us. So in year 30, we're at 385,124. 385,124. So these are the same policies. $1 million, 45-year-old male. Pac Life, the fees through 30 years are $385,124. Minnesota Life, total fees $342,190, and then you have your Allianz policy $144,394. Now, there's a lot of things going on here that we're not talking about because none of these policies are particularly designed for maximum tax-free retirement income. So it's important that you understand the difference here is just in the actual policy fees based on a set amount of coverage. Now, if you want to make sure that your policy is designed correctly, I'll link a video above where I talk about how to design these policies for maximum cash, maximum tax-free retirement income, because that's not the purpose of this video. The purpose of this video is to show you that across carriers, there are drastic differences in fees. And so you should be looking at several carriers to make sure that you're getting a policy that's going to work for you and going to be efficient for you. Now, why does this matter? Because I know that some people are going to say, well, maybe those other policies have some bells and whistles that other policies don't have. And that could be true. But again, it goes back to what we talked to at the very beginning. Fees are going to happen every single year. So if you have a policy where your fees are 3 times higher than maybe the industry average, like that Pac Life policy that we just looked at, if you have a policy where the fees are 2 to 3 times higher than the industry average, those fees are going to come out every single year, whether or not the bells and whistles work. My advice to you is to make sure that you have a policy where the fees are reasonable and that you don't let the bells and whistles tail wag the dog. Because if you have a stretch of time, let's say you go back to 2000 to 2002, where the market performed at 0%, basically 3 years in a row. If you have a stretch of time over 3 years where your policy performance is 0, 0, 0, and yet you've got a policy where you're paying fees that are 3 times the average, that can add up really quick, and that can do a ton of damage to your policy. So I hope that that makes sense. If you already have an indexed universal life insurance policy and you want to get it reviewed, I would encourage you to do that. You probably need to be having life insurance policy reviews every single year to make sure that you're still on track. But if you've never compared the fees that you're paying to what else is out there in the marketplace, you absolutely need to get a life insurance policy review. I will link a webpage in the description below, and I'll pin a comment where it goes straight to my website. You can apply for a policy review. We'll go through your policy. We'll make sure that you have something that's structured the right way, that's going to do what you want it to do, and make sure that you're not paying 2 to 3 times more in fees than what you should be paying. If you're interested in looking at an indexed UL policy for something like tax-free retirement income or diversifying away from market risk, you can go to that same website, you can fill out the form, and we can schedule a time to talk. I hope that this was helpful. Again, check out that video linked above on structuring your policy for maximum cash and income, and I look forward to hearing from you soon.